Okay, so hi guys, I hope you all are doing well. Welcome to this session of strategic business reporting. My name is Luqman Rafiq, and I'll be conducting this session. We have actually planned this session for a period of 6 days, which is going to be every alternate day. We would be having a class pertaining to this specific area. And let me just give you a bit of a guidance that what I have done is that I have planned for the different topics on different dates. And the first basically topic that I would start off is about the consolidation. Also, let me just give you a bit of a guidance as to what we would be doing is that we would actually be practicing the questions on the ACCA CB practice platforms. And while practicing the question on the ACCA CB practice platform, what we would try to do is that we would try to cover up almost all areas of the syllabus based using the past papers as a starting point. So I would try to do almost all areas of the syllabus using the past papers. Now, let's just start off. So I think that every one of you has access to the ACCA CB practice platform. I would start off discussing from the CB practice platform, and the topic. The first thing that I want to start off is like I want to go about with the latest examination question paper, because the latest examination was about the group cash flows, and majority of the students struggle to do the group cash flows. So what I would do is that I would start off discussing about this group cash flows and would take things forward from it. Okay, so what I'm actually going to start off is the consolidated financial statement questions, because it is confirmed and it is guaranteed that in the question number one, you will get consolidation. It could be consolidated balance sheet. It could be consolidated profit and loss account. It could be consolidated cash flow. It could be anything. So you as a student got to be ready for this consolidation. Now let's just start off. This is the question, the name of which is Cabello Company. Its case, Cabello is the parent company of a group whose financial year end is 31st December 2005. So the financial year is 31st December 2005. The following exhibits available on the left-hand side of the screen provide information relevant to the question. So there is the detail of acquisition of Trudeau's company that provides complete information regarding acquisition of Trudeau's and other information relevant to complete the consolidated statement of cash flows. Financial instruments contains information about a number of financial instruments, contains information about held by the Cabello Group. Then consolidated statement, this includes the draft extracts for the consolidated statement of cash flows together with extract from consolidated financial statement for year ended so and so. Now, what exactly is the requirement of the question? The requirement of the question is like this. It says using the pre-populated spreadsheet to prepare revised extracts for the operating and investing activities. See, The examiner is just asking you to prepare the operating and investing activity. He is not asking for the financing activity. Explain the adjustments required to correct the operating and investing activities of consolidated statement of cash flows for the Cabello Group for the year ended so and so on. So you have to adjust the pre-populated spreadsheet. You have to explain each of the adjustments that is there. And using Exhibit 2, advise the financial controller as to how the various financial statement instruments, including overdraft, should be presented in the consolidated statement of cash. Then what else is there? So this is basically the requirement of the question. Now let's just start off. I would start off with the acquisition of Trudeau's company. I would give you 5 minutes to read through these questions, and then I would start off discussing alongside you people. Now, can you just go through it, please? Can you just go through it? We will start discussing. Okay, if we talk about it, it says Cabello acquired 80% of the 100,000 equity shares. How much have you acquired? You have acquired 80% of the 100,000 shares of Trudeau's company on 30th June 2005. So when have you acquired? You have acquired it on 30th June 5. The consideration consisted of a cash payment of $5 per acquired share, an issue of one Cabello company's $1 equity share for every 4 shares acquired in Trudeau's company. So the consideration comprises of cash. The consideration comprises of the shares. Cabello's policy is to value NCI at fair value. Fair value of Cabello and Trudeau's shares were this respective. Now, it says the carrying amount of the net assets reported by Trudeau's company as on 30th June 2005 were as follows. So property, plant, equipment, the inventories, the receivables, cash and cash equivalents, trade payables, so on and so forth. The only fair value adjustments on acquisition related to plant which had a fair value of $50,000 above its carrying amount. So that was the only fair value adjustment. The group pays tax at 30%, and deferred tax was correctly accounted for within the consolidated statement of financial position. Taxation figure in the statement of profit or loss for the year ended 31st December 2005 is 385,600. And this figure has been included as taxation paid within the draft statement of cash flows. Financial controller has accurately completed the consolidated SOFP and SOCI, but the consolidated statement of cash flow is in draft. Financial controller has not yet considered the impact of acquisition on the consolidated statement of cash flow. So that's a very big omission that he has done. He has not considered the impact of acquisition of Trudeau's company on the company's financial statements. Now what next is there? The next situation is, it says the statement of cash flows figures for movements in inventories receivable, payable, and PPE have been calculated by considering simply the differences in the year-end balance in the consolidated SOFP. So what they've simply done is that they've considered the opening and the closing balance difference. They have not incorporated the effect of acquisition. It says goodwill of Trudeau's was impaired during the year. There were no other goodwill impairments. Depreciation for the charge for the year was this. There were no disposal of non-current assets by the group during the year, although there were some additions paid for by cash. So they've given a complete information. Financial instruments details are given. And then consolidated statements. So if we talk about the consolidated statements, it has actually given you the extracts below have been replicated in the pre-populated spreadsheet response options, which is draft extract from the consolidated statement of cash flows for the Cabello Group, the cash inflows from the operating activities, from operations so and so, the extract from consolidated finance statement of financial position of the Cabello Group, and so on and so forth. Now the requirement of the question is that you have to adjust the pre-populated spreadsheet to prepare revised extracts, and you have to explain the adjustment required to correct the operating and investing activities. Let's just come on to this pre-populated spreadsheet. Let's try to see that if there are any adjustments that are required to be done. Okay. So it says the draft extract from the consolidated statement of cash flows for the Cabello Group for the year ended 31st December 2000 X5. Cash inflows from operating activities are given. The profit before taxation is given. The depreciation is given. The change in the inventories is given. The increase in the receivables is given. The increase in payables is given. Then there is this taxation paid, and then the cash inflow from operating activities is there. Then the cash inflow from investing activities, so on and so forth. So what is the adjustment that we have to do? Let's try to do this. So one by one, let's just start discussing. Cash inflow from operating activities, profit before taxation is what it is. So profit before taxation is not given here. I'm assuming it is how it is. Then the second thing is that I will go about discussing the things. One by one. Depreciation, it says 625,060. How much was the depreciation? Because there was a mention that he has not incorporated anything from with respect to the group. See, there was something mentioned in there. Financial controller has not yet considered the impact of the acquisition of Trudeau's company on the consolidated statement of cash. The depreciation charge for the group was 625,060. There is no change to it. This is okay. Then the increase in inventories is 658,100. You have to understand this, that during the year 256,800 was the inventories that was existing in the subsidiary that you acquired. So basically, the increase in inventory is shown as a cash outflow, that is okay, but from this 256,800 was the increase because of acquisition and not because of operation. Should explain this. So one of them is inventory. The existing movement of the inventory does not include the impact of the acquisition. The effect of the inventory of Trudeau's existing at the date of acquisition should be removed from the inventory movement determined. So the whole of the inventory movement is not because of the uh, operations, but rather some of this is because of the acquisition. Now what next is there? There is this increase in trade and other receivables. There is an increase in the trade and other receivables. We got to see, were there any receivable balance at the time of acquisition? Yes, 220,300. So basically what happens is that so it's like gonna be the same adjustment for trade and other receivable. So when we talk about the trade and other receivable, what exactly do you mean by that? The concept of trade and other receivable is going to be the existing movement of trade and other receivables does not include the impact of acquisition. The effect of the receivable balance of Trudeau's at the date of acquisition should be removed from the receivable movement which is determined. So here what has happened is that it rather ended up being a decrease in trade and other receivables. It's a decrease in trade and other receivable. It rather ended up being a decrease rather than an increase. Now similarly, when we talk about the trade and other payable, so there is this 175,400. So there is a decrease in trade and other payable. There is a decrease in trade and other payable. The effect of the payables existing at the time of acquisition were to be incorporated. After incorporation, the payable balances the payable balance was considered to be decreasing rather than increasing. Right? That's number 3. Now that's number 3. Now what next is there? So there's this cash generated from the operations, and then you have got the taxation paid. We have considered inventories, we have considered receivable. The cash and cash equivalent we'll consider it later. The trade payables is this. So, like in here, they say that they have paid the taxation. It was mentioned how much taxation has been paid. It says the taxation figure in the statement of profit or loss for the year is 385,600, and this figure has been included in taxation paid. How much taxation has been paid? Okay, for the taxation paid, we would have to do some calculations. Taxation. So what's going to happen with respect to taxation is that opening of this is going to be this plus this in fact I've taken the wrong values, this plus this so we have the closing liabilities now. The opening is there, the increase or decrease needs to be incorporated, the taxation paid needs to be incorporated, and we have the closing liability. Now if we try to establish that how much was the expense for the year. Yes, the session has started. Okay. Now, if I talk about it, how much has been the tax expense? This is the figure that needs to be shown in the financial statement as a tax expense. So how much is it going to be? Let's just try to see. $385,600. This is going to be the balancing figure as this minus this plus this. So it's like 398,200. So what you would do is that you would say the taxation paid is gonna be 398,200. So what would you do? You would say there is this word processor, the taxation paid. The tax that is the tax presently shown in the cash flows is the tax expense for the period. The cash presently shown is the tax expense for the period. In the cash flow statements, it is the cash that is actually paid is shown as an expense. The tax that is actually paid is shown as an expense, is shown as an outflow. So the outflow is established and that is reflected in the taxes paid. Now we need to move a bit forward about the next aspect because the question's requirement was about the operating and the investing activity. He's not asking us for the financing activities. He's just asking for the operating and the investing activity. Now let's try to understand further. So we've been able to rectify this, and this. The tax is paid. I just need to see if there is anything else that I need to do with respect to it. Okay. Apparently, we would have the revised cash inflows from operating activities, which is gonna be what? You need to understand the cash generated from the operations is gonna be the sum of all of this. Then this plus this. So cash inflows from operating activity is 1370960. 1370960 is the cash inflows from the operating activities. We now need to move a bit forward and discuss further. So there is this cash inflows from operating activities and then the investing activities also that needs to be shown. Let's just try to see. So when you acquired the subsidiary, there was this property, plant, equipment of 421,000. There was this fair value adjustment of 50,000. So now what we need to do is that we need to see, it says the acquisition of property, plant, equipment of 543,600. How has he been able to establish the acquisition? There was something mentioned here that how have they written the figures? Okay, so see what happens is that the existing PPE do not incorporate the effect of PPE available at the time of acquisition of subsidiary. The movement should eliminate the effect of the PPE acquired due to subsidiary acquisition. Now, so basically, what have I done? I've actually used this 543,600 plus 421,000 plus 50,000. Right? Okay. Now what else is there? So, like we have incorporated PPE also. Now there is also the acquisition of the subsidiary. Consideration paid to acquire this, not yet calculated. Okay. So do the calculation for the consideration paid to acquire. So you know this thing that it says Cabello acquired 80% of the equity shares. The consideration consisted of a cash payment of $5 per acquired share. Okay, is there any mention of the excess depreciation? Is there any mention of the excess depreciation? Is there any mention of the excess depreciation, please? I don't think that it is available in the examination question anywhere. The excess depreciation, I don't think so that it is available anywhere. See, you have to calculate, but at the same time, has he mentioned anywhere that what was the remaining life of the asset? Has he mentioned anywhere how much was the remaining life of the asset? He has not mentioned anywhere. Now, anyways, it says Cabello acquired 80%. So you just have to ignore it, Michael Cotto. Cabello acquired 80% of the 100,000 equity shares of Trudeau's on 30th June 5. The consideration consisted of a cash payment of $5 per acquired share and an issue of one Cabello share for every 4 shares acquired. So it's a number of shares acquired. How much is the number of shares acquired? 100,000 into 80%. The number of shares issued. You are being told that what happened is that the consideration was you also issued one share for every 4 shares acquired in Trudeau's. Is equivalent to this divided by 4 multiplied by 1. 20,000. Now, the consideration is gonna be cash paid is this multiplied by $5. Fair value of the shares issued is gonna be this, the number of shares which is issued multiplied by. So the share of Cabello had a market value of $13. So you issued your own shares, which was worth $13 each. So resultingly, the consideration paid is this. If I try to calculate this, you got to understand that the cash outflow is what? The cash outflow is 400, in fact 4 million. And what you would have to do is that you would have to add up. Add up what? When we acquired subsidiary, there was 24,900 cash available. All of it is not outflow. The whole 400,000 is not the outflow. You have been able to recover the 24,900 from it. What have you been able to do? You have been able to recover 24,900 from it. What you have been able to recover 24,900 from it. So the net cash outflow is a bit different. Now let's discuss a bit further. So I'll just try to calculate the goodwill also because there has to be a reconciliation for the goodwill too. Fair value of NCI. How do you calculate the fair value of NCI? It's like number of shares owned by NCI multiply the market value of each share. It was $8. It is actually going to be 8 multiplied by 100,000 multiplied by 20%. So hence, what actually happens is this is the fair value of NCI less fair value of identifiable net assets. Carrying amount. The carrying amount was 747,600. The fair value adjustment at the time of acquisition was of what? Of 50,000. Then what actually happens is that if 20% is the tax rate, this is what the deferred tax liability is going to be. In fact, not 20, it is actually 30%. I bet it is actually 30%. What is it? It is actually 30%. Now let's move a bit forward and let's take a bit forward and discuss further. So what happens is that you need to establish the goodwill. So hence, now the goodwill is gonna be what? Is gonna be this cost of investment plus the fair value of NCI plus this. So 37,400 is the goodwill. I bet 37,400 is what? The goodwill. Right? 37,400 is what? Is the goodwill. Now, what we need to do is that we need to reconcile the goodwill accounts also, because that is going to help us identify impairment. Opening goodwill for this company was how much? You acquired a subsidiary for 37,400. So the impairment loss is gonna be, I don't know how much, but we know the closing amount, which is this. The impairment is gonna be what? The impairment is gonna be, I'm sorry, I mean like, was my voice audible because I had actually just put the mic a bit across? So I mean like, was it clearly audible or not? Okay. Now see, the impairment loss is gonna be what? It's gonna be this minus this plus this. So there's a 31,100 impairment loss. What would we do? We would add it up here. Impairment of goodwill. Since it's a non-cash item, it needs to be added up. The goodwill's account, when reconciled, leads to a difference which could be explained as an impairment loss on the goodwill. The impairment loss is a non-cash item and needs to be added up. So what happens is that the impairment of the goodwill needs to be added up. He has given us sufficient information about the PPE. So I think rather than just jumping onto the conclusion, we should recon the PPE also. So the property, plant, equipment at the start of the year, it's given in the question, it was this. It was this. Now, now it says that you acquired 421,000 here, 50,000 here. So we have been able to establish the movement because of this subsidiary acquired. Then you've got the depreciation. Okay, so it's actually gonna be 2971240. And how much has he given to us? He's given to us in the question already. And that was how much? 3,668,900. So the opening assets were this. The subsidiary was acquired on which there was this asset. The depreciation around arise during the year was this. Let me just put it in the minus sign. And now what we have is that we have the closing available also. So we need to reconcile that what is going to happen now. So there is probably going to be an acquisition. I bet there is probably going to be an acquisition, which is going to be this minus the sum of this all. 697,660. So what I'll just do is that from this, I would say this is simply minus this amount. This is something that has gone out of the book. Is there anything else left that you think that we should account for it? Yeah, is there anything else that you think we should account for in it? Okay, always remember one thing, that whenever the opening and the closing figures are given, the balance sheet extracts are given, just do the reconciliation. Similarly, like what I did with respect to goodwill also, I said that, okay, I need to see if the account is reconciling or not, and it was not reconciling. So we had a goodwill impairment recognized. So apparently, this is what the requirement of the question was. And we have been able to attempt the requirement, establish what is relevant. Now, what else is the requirement of the question? The second requirement of the question was explain the adjustment required to correct the group investing, operating and investing activities of consolidated cash. So we have already discussed these things. That what are the things that you need to discuss? We have already discussed them. Now, what else is the third requirement? Advice as to how the various financial instruments, including the overdraft, should be presented in the consolidated statement of cash flows. Yeah, what other financial instruments you can think of? What other financial instruments you can think of? Yeah, please, what other you can think of? Do let me know what other financial instruments you can think of. Do let me know, please. See, with respect to this receivables and the payables, he has not given much information. It was just that the receivable and payable movement for the year was given. So now what we had to do was that we had to actually incorporate the effect of the acquisition of subsidiary. Now, what is the requirement here? Advise financial controller on how to account for the finance instrument. Now, what is this requirement? He says Cabello Group has a number of financial instruments presented within its consolidated statement of financial position. Some group entities which had surplus cash resources had acquired debenture and other non-group entities to increase return. Other had raised finance by issuing bonds. Cabello financed the acquisition by acquiring a bank loan. They have also an overdrawn bank balance. The overdrawn bank balance fluctuates regularly from an in-funds balance to an overdrawn balance. What's the requirement that they have? Using Exhibit 2, advise the financial controller as to how the various financial instruments, including the overdraft, should be presented. So let me just guide you. The treatment of different financial instruments, how it is going to be. It says they have got a number of financial instruments presented within its consolidated balance sheet. Some group entities had cash resources and had acquired debentures in other non-group entities to increase their returns. So what do they have? The debentures are there. Cash reserves are there. Overdrawn balance are there. Issued bonds, bank loan, okay. So how would you account for all of this? The debentures, what they've invested in debentures or what? The investment can be accounted for as at financial asset at fair value or fair value through profit and loss or as at fair value through OCA. Or as at amortized cost depending upon the purpose of investment. So depending upon what's the purpose of investment is going to be, on the basis of that, it would actually be given the treatment. Then what else is there? The cash reserves. So what would you say about the cash reserves? You would say the cash balance is to be shown under the heading of cash and cash equivalents. The overdraft balance is to be shown under the current liability. Issued bonds to be presented as financial liability at amortized cost. They are to be presented at financial liability at amortized cost. So basically, we have been able to identify these treatments of the different financial instruments also. So up till now, this is what the question's requirement was. Now, why did you people get stuck in the examination when this specific type of question arise? Yeah, do you understand this? So what was the reason? So basically, okay, so what I've been able to do is that I've been able to conclude this question, which was about the group cash flows. And this was one of those questions that was poorly answered, poorly answered. The students, they just did not answer this question properly in the examination. So just remember, if you come across such a question in the examination, you got to make sure that you answer these questions properly. Got to make sure that you answer these questions properly. And for that, go step by step, step by step, step by step. That way you will be able to do the answer. Okay. So what I'll just do is that what will be shown in the cash flow? How do you want to show in the cash flow, my friend? Have you forgotten everything about the cash flow? Okay. See, I've practiced this question with you. Just go through it. Okay, 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 okay. Just wait a bit. Just wait a bit. Obviously, we have not covered up the financial instrument revision right now. So you may not be able to get it, but I've actually shown that how these would be shown in the income statement, the financial statement. Now, what would be the impact on the cash flow? Let's talk a bit about it. Okay. So what would happen is that you have to talk about how it would impact the cash flow, which we are going to cover up later in the next class. But for the time being, this is basically question number one. That was about this company, the name of which was Cabello Company, which we have been able to do. So just in case if any one of you has got any questions till now, you are most welcome to ask. Right? Okay. Does it make a bit of a sense or is it still confusing? The cash flows. Okay, lovely. So that was basically one of the latest examination question in which students perform pathetically bad. They just could not do this question properly, and that was because nobody expected that it is going to be cash flows. So resulting was that almost everyone who got stuck with the cash flow wasn't prepared for the cash flow. They got badly stuck in the examination, right? Okay, so what I'll do is that I'll just keep it till here for today. I will join in inshallah on the class for tomorrow, and I'll take up the group accounts again with you. So thank you all. Thank you for your time. Thank you for being here.